On July 1st, the biggest surprise starting the second half of 2026 is the sudden transition from AI chip scarcity to potential compute oversupply. Meta is upending the infrastructure trade by planning to sell its excess compute capacity directly to the cloud market. Initially, Mark Zuckerberg insisted that Meta would hoard every chip for its own models. Now, they are planning to sell compute and model access, entering direct competition with AWS, Azure, and Google Cloud, which immediately triggered a sell-off in specialized compute rental stocks. This compute shock coincides with a massive style rotation. While the S&P 500 has logged a respectable 7.5% gain year-to-date, the Russell 2000 small caps have surged over 22%, signaling a healthy broadening of the market. But not all infrastructure plays are being blindly bid. Michael Burry has disclosed a short position in industrial giant Caterpillar at over $1,000. Burry is citing 30-year high price-to-sales ratios, warning that the infrastructure buildout is hitting a valuation peak. This skepticism is backed by projections that free cash flow for major hyperscalers could collapse towards zero over the next 12 months due to non-negotiable AI capital expenditures. The market is shifting from tracking chip counts to checking cash sustainability. IBM is taking a different path to reset its terminal value. The company announced a sub-1 nanometer semiconductor architecture using stacked transistors, alongside a billion-dollar public-private partnership for a dedicated quantum chip foundry in New York. This breakthrough positions IBM as a crucial hardware supplier for government and defense applications. Rather than relying on simple model scale, IBM is carving out a role in national hardware sovereignty, decoupling it from general software sentiment. On the macro front, the era of a predictable Fed is over. Chair Warsh has signaled he will not provide forward guidance for July meeting, leaving the market to interpret economic data in real time, which will likely raise the baseline volatility for the summer. Despite recent cooling in the jobs data, model projections suggest the Fed remains 2 rate hikes behind the neutral rate curve. The consensus is shifting toward 1 to 3 interest rate hikes in the second half of 2026, with 0 cuts on the table. This hawkish pressure is driven by structural labor dynamics. U.S. labor supply is contracting at minus 1.7%, while demand is growing at nearly 20%. This imbalance creates a sticky floor for core inflation, complicating the Fed's target. Even with macro pressure, memory demand remains historic. Micron reported a massive 346% year-over-year revenue increase, backed by 16 long-term contracts worth $100 billion, suggesting a less cyclical business model. However, this hardware demand is raising costs down the chain. Surging memory component prices have reportedly forced Apple to raise prices across its Mac and iPad lines, testing consumer demand elasticity as hardware suppliers command more pricing power. As July begins, the H2 playbook requires active watchfulness. We are monitoring the compute price war triggered by Meta, IBM's hardware execution, and whether the Russell's breadth can hold. The bull market is broadening, but predictability is gone.